Welcome to Fall into ETF Investing. On today's special episode, our panel of guest speakers will be discussing gain from falling rates, positioning equities, sectors, and fixed income.
Thank you for joining our Fall into ETFs special edition of ETF Market Insights. I'm Erin Allen with BMO ETFs. ETF Market Insights is a weekly series that looks to provide do-it-yourself investors with important insights to help them manage their own investments. In this episode, we'll be looking at the current interest rate environment and what a declining rate cycle could mean for your portfolio and some opportunities it might present. Today, I'll be passing off my hosting duties to Cornell Schreiber, well known as the host of the popular Build Wealth Canada podcast. Cornell was part of the FIRE movement and has been semi-retired for years now and loves to discuss personal finance and ETF investing on his show. Before I turn it over to Cornell, a quick reminder that today we're not providing any investment advice or recommendations. Today is all about education. Cornell, over to you.
Welcome everyone to today's ETF Market Insights, where we dive into how investors can position their portfolios in response to falling interest rates. I'm thrilled to be your host today as I guide you through an insightful discussion on a timely topic, how an investor could position their portfolio to benefit from falling interest rates. Joining me today, I have two very special guests, Marcus Otima, who is market maker at CIBC Capital Markets. Marcus has 18 years of international capital markets and asset management experience, which he gained working in fixed income trading and portfolio management roles at a variety of financial institutions. Also with me today is Matthew Montemuro, who is head of fixed income and equity ETFs at BMO Global Asset Management. Together, they'll discuss key strategies for positioning fixed income, equities, and how to make the most out of this market shift. Let's jump right in. Marcus, let's start first by discussing the impact that interest rates can have. What impact does a falling interest rate environment tend to have on the broader fixed income market as well as the equity market, and which one tends to benefit?
Sure. I think when you're talking about falling interest rates within a fixed income portfolio, let's say, your starting point matters. So if you look back a few years ago, interest rates were quite low. Maybe the return potential from a carry perspective was pretty low. And I think a lot of people got quite burned when interest rates rose in response to inflation by central banks. We now have kind of the opposite scenario where inflation is coming under control. The economy maybe is showing signs of slowing, and interest rates are coming down, both through central bank activity. We've had the Fed now launch their first cut, 50 basis points. The Bank of Canada's gone 3 times at 25, and so we're starting from a higher base. And so, what does that mean from a return perspective? Is that you can position in various ways. So one is you can be long, short-dated, bonds. Let's say you can be long, short-dated, 2-year notes. If you are, you have a carry, let's say, of 3%, and then the bank cuts by 25 basis points. 25 basis points on a 2-year note will give you 40 basis points of additional return. Whereas, if you're positioned further out the curve, let's say, a 30-year bond, for instance, 25 basis points is a 5% capital gain. So how you're positioned matters. How the curve, how interest rates fall across the curve matters in the sense that, the curve can and often does steepen when central banks start engaging in cuts. And that's just purely because the front end is really driven by central bank expectation, and further out the curve is driven by inflation expectations. So both can come down. So you really are juggling, your starting point, how much carry you have. So your carry is one component, your capital gain component, and then your duration component, so your risk, how exposed you want to be to interest rates. And then on the equity side, there are things that like REITs that benefit from lower interest rates, lower borrowing costs, or you can have growth stocks that benefit from just having a lower discount rate. Means that the earnings are basically like your net present value, future earnings is increased. So they can be a benefit from that as well.
Great. Matt, this can get quite exciting as there are some sectors that tend to do better in a falling interest rate environment. Can you provide some context on what sectors tend to do well?
Yeah, absolutely. So when you look back, what happened over the last couple of years, as interest rates went up, you saw on the fixed income side, a lot of investors hide and shield their portfolios, positioning themselves on the short end. That was a beneficial trade because it insulated them from the impact of rising rates, but then also allowed them to capture the benefits of an inverted yield curve. So what do we do now that we expect to be in a prolonged cutting cycle? So in fixed income, we expect that investors will look to add duration to portfolios. They're going to start moving further out the curve, as Marcus was saying. So looking at aggregate exposures like ZAG or ZDB, that gives you full term exposure, allowing you to stay invested across the curve, but still getting that long end exposure that will benefit from rates coming down. We are very constructive in spread products. So provincials and corporates, we think are going to outperform in the period ahead. So if you look at things like ZCB, that gives you full term exposure, but focuses on the corporates. ZQB, that gives you a quality bond exposure. So again, it insulates you from some downside protection by providing higher quality bonds, but still gives you that added yield that corporates provide. And then there's going to be investors who just want to add tactically. And I would look at adding some long duration exposure. So ETFs are excellent tools to allow you to target that long end. And you can do it in terms of provincials, so ZPL, corporates, ZLC, or in the government, so ZFL in Canada or ZTL in the US. So that allows you to get that exact long exposure. And as Marcus said, when rates are coming down, you want some of that long duration exposure to provide that capital gain in your portfolio. Looking on the equity side of your portfolio, we right now favor a quality core, looking at companies with very strong balance sheets. So we like ZUQ, US high quality ETF, focusing on the strongest companies in the US. As well, if rates are coming down, again, the discount rates are coming down, we like small and mid caps. So Z small, Z mid, I think would be very well positioned for the period ahead. And then if you want to look a little bit more tactically and you want to look at a sector perspective, what sectors perform well when rates come down? You have financials, you have healthcare, you have utilities, you have REITs. I think all four of those, looking at the ETFs, if you have ZEB, ZRE, ZUT, and ZUH, all of those will be very well positioned to take advantage of a prolonged cutting cycle that we expect for the remainder of 2024 and then into 2025.
Great. And Marcus, with rates falling, the fixed income environment has changed. What sort of strategies can investors utilize to best protect their own portfolios while still staying within the environment, still staying in the market?
Sure. So I think one angle is just from an asset allocation perspective. So if you look at your overall portfolio holdings, like equity and fixed income, whatever your percentage may be, if it's 60-40, 30, whatever, you need to think about what is the role of fixed income in your book. So if the idea for fixed income is to give you ballast for when maybe there's a market turn, you probably want to have a higher allocation to fixed income in the sense that you now have a better starting point. You do have that carry component. You do have the benefit that interest rates falling can play into your portfolio, which you didn't have back in 2020. So that's one area. The other is how you position. So Matt just listed off some really some great trade ideas there. So like the idea of extending duration definitely makes sense. Having how you extend your duration, how much credit you want to have in your portfolio also becomes a question. So a pure play like a ZFL is an easy way to get just a pure duration component without that credit risk component. If you're worried about, again, if you're building your portfolio and you want that ballast piece, then having some ZFL makes sense in there. If you are looking for income, then you may want to switch around the other way, right? You may want to have distributing, paying, or you may want to have some like a high dividend, like a higher allocation of high dividend and maybe some cash components, if that's really what you're after. You think about, again, the starting point, like mentioned, it matters. It's if you were to build a 5% portfolio, like let's say 5% was your annualized target, you can basically achieve that almost entirely in fixed income, right? So whereas a few years ago you had to be almost entirely in equity, and if you wanted to, and if you wanted to have some fixed income in there to not offset your earnings potential, you'd have to dip your toe into high yield or even into private credit to get 4.5%, 5% strike points. But we're not there. We have a front end of the curve that's at 4%, and so you can have a risk-free return that is or more or less risk-free return than you did before. Before it used to be return-free risk. You had 10 years at 50 basis points, so you basically had no carry, and you had only upside rate potential, meaning that you'd be locking in losses. So I think that allocation, it's important to think about what's the role of fixed income within your portfolio before you move on to decide how to allocate.
Great. Matt, let's finish off by looking ahead. What do you anticipate happening in terms of monetary policy? And what are the key considerations that us investors should have when it comes to our own portfolio construction?
Yeah, so you look now, I think it's well, agreed upon that both Canada and the US, they have started their cutting cycle. I think we're going to be in a very prolonged interest rate cutting cycle. Rates are going to be coming down, and we're going to probably look at a midway point of kind of 2.5% to 3%. I think is where a lot of economists have kind of targeted where we think the long-term neutral rate will be. As Marcus said, very different than where we were 5 years ago in kind of that zero interest rate environment. You're still getting kind of that 2.5%, 3% as the long-term rate. So if I look forward now, what's the market pricing in? Canada already cut 3 times this year. The expectation is they're going to continue to cut into 2024. For the next meeting in October right now, 25 basis points is priced in and about a 55% chance of a 50 basis point cut. I think, the Fed coming in September at 50 basis points, that catch-up cut, the mega cut that they implemented, maybe gives the Bank of Canada a little bit more freedom to maybe do a copycat cut in terms of 50 basis points. So that'll be very interesting to see if they go that way to kind of speed up the cutting cycle. For the rest of 2024, the market is pricing in 75 basis points in Canada and then another 100 basis points for 2025. So that would end 2025 at around a 250 overnight rate in Canada. Looking in the US, again, they started their cutting cycle a little bit later. We do expect another 75 basis points to come in for the Fed in 2024, and then 125 basis points to happen in 2025. So again, Canada and the US continue to look like they're in lockstep. The differential at the end of 2025 looks to be about 50 basis points, which is kind of where we've been for the last year or so. And then, so if you're looking and you're expecting a prolonged cutting cycle, the things you got to think about when you're positioning your portfolio, on the equity side, how is my portfolio positioned to take advantage of rates coming down? You may have been, overly in quality. Maybe you want to reduce, adding kind of some of those small and mid caps to take advantage of, maybe a little bit of a looser economic cycle and looser policy options in the US. You want to add those sectors that are going to benefit from rates coming down. And in fixed income, both of us had mentioned it, adding duration. We've been short for quite some time, and I think that was the winning trade while we saw rates go up and we saw that inverted yield curve. But I think going forward, the big driver of performance will be duration in portfolios.
All right, gentlemen, thank you so much for your expertise. That wraps up today's conversation on ETF strategies for falling interest rates. A huge thank you to Matt and Marcus for sharing their insights and knowledge. If you have any questions or thoughts on the strategies discussed, we'd love to hear from you. Please comment below and let's continue this conversation. Also, please don't forget to subscribe for more great content like this. See you soon.